Hi, welcome back to Blueprint for Wealth and your educational moment. And today we're talking about alternative investments. We just heard about an expert in alternative investments. Let's learn a little bit about them. So let's talk about what an alternative investment is, how do they work, and what's the regulatory environment today for them, and what are some of the AI alternative investment strategies that we're looking at today. An alternative investment is an unconventional financial asset. It's unconventional or not conventional in the sense that it's not cash, it's not stock, and it's not a bond or mutual fund, which means that it's something different. And what could that be? Well, it could be a tangible asset or an intangible asset. The tangible assets include precious metals like gold and platinum. They include commodities such as real assets that are mostly natural resources, maybe agricultural products, oil, natural gas. It may include real estate and personal property, such as equipment or antique vehicles or fancy vehicles such as Maseratis and Ferraris, and other hard assets that fall into this category. And it may include collectibles. There's a great list on the website that deals with alternative investments for Investopedia, and they list the following as potential collectibles that people engage in investing in for profit, such as rare wines. I mentioned vintage cars, fine art, mint condition toys. Imagine that Buzz Lightyear toy that has never been opened before in a mint package. Stamps, coins, and of course, one of my favorites, baseball cards. Intangibles include hedge funds, private equity and venture capital, and private debt and structured products. When we're talking about private equity, that really includes a broad category that refers to capital investment that's made by investors into private companies, or essentially companies that are not listed on a public exchange like the New York Stock Exchange or NASDAQ. There are many subsets of private equity. Venture capital is one of them. That focuses typically on startups and early stage ventures. Also, growth capital, which helps more mature companies expand or restructure, or buyout funds, where a company or one of its divisions is purchased outright by a merchant capital fund. An important part of private equity is the relationship between the investing firm and the company that receives the capital. Private equity companies often provide more capital to the firms they invest in. They also provide benefits like industry experience or talent sourcing or mentorship to the founders of the business. Private debt typically refers to investments that are not financed by your typical lenders like banks or traded on an open market. The private part of this term is really important. It refers to the investment instrument itself rather than the borrower of the debt, because both public and private companies can borrow privately. Private debt is leveraged when companies need additional capital to grow their businesses. In fact, private equity firms often use private debt sources to help finance acquisitions of private companies. The companies that issue the capital are typically referred to as private debt funds, and they make money in two ways: through interest payments and the repayment of the initial loan, plus maybe an equity kicker on top of the initial loan. A hedge fund is an investment fund that trades relatively liquid assets and uses various investment strategies with the goal of earning a high return on the investment. Hedge fund managers specialize in a variety of skills to execute their strategies, such as long-short equity or market-neutral investing, or volatility arbitrage, or quantitative strategies that use algorithms to trade the securities. They're usually exclusive and available only to institutional investors such as public endowments of universities or pension funds. How do they work? Well, as I mentioned, the alternative investment world typically favors institutional investors because it requires a lot of capital and a lot of certainty to invest in these products. It also may be extended typically to accredited investors, wealthy investors, people who have more than a certain level of income and are sophisticated at investing. Because of the way these funds are structured and these assets are invested in, they're illiquid. They cannot be sold easily like stocks and bonds can be on the public market. And because of that, they're harder to value. There may only be one kind of gold coin that exists in the world of that specific type from that specific year, and therefore, how do you value it? Or a piece of artwork. Auction houses typically get involved with that. Appraisers get involved, but it's really what a willing buyer is willing to pay a willing seller. And again, AIs are uncorrelated to conventional asset classes, which means that they move up or down independently of where the stock market and the bond market go. Importantly, they're unregulated. Now, that doesn't mean they're completely unregulated, as you'll see in a minute, but because of their unique qualities and because they're so illiquid and it requires a significant amount of risk tolerance to invest in, they're not available to everyone. Now, when I say AIs are generally unregulated, it's the AI funds and managers that could be subject to regulation. First of all, limited partnerships and limited liability companies are formed under state law and subject to state law regulation. The Investment Advisors Act of 1940 may cause alternative investment fund managers and investment advisors who sell these funds to be treated as investment advisors who must register in order to sell these funds. The private fund advisor exemption may actually exempt many of these large fund managers, but most people who get involved with alternative investments may need to register under the Investment Advisors Act. And then states also independently regulate and require registration of investment advisors that sell alternative investments. The Investment Company Act of 1980 may require alternative investment funds to register with the Securities Exchange Commission if they exceed certain size, more than 100 investors, or do not contain qualified purchasers who have a certain level of assets and sophistication. Otherwise, they're not licensed, they're not authorized to do business, and they're not regulated to invest in and sell ownership interests in AI funds. So because of that, you've got to be cautious in what you invest in terms of alternative investments. So the AI strategies that are incorporated today, again, institutional investors, pension funds, endowments of large universities, big union investment funds have lots of funds available to allocate a portion of their portfolio to diversify the portfolio and invest in alternative investments. These investments, again, have a low correlation to stocks and bonds and cash. Accredited investors also may participate through their investment advisory firms. But today, non-accredited, regular retail investors can participate in exchange-traded funds and mutual funds that engage in the investment in alternative investments. But the fees and the risks of those investments usually are quite high. And again, hard assets like gold or oil and gas investments or real estate offer a hedge against inflation and may make sense. If you want to know more about alternative investments, we can refer you to a qualified investment advisor or investment manager to help you make decisions on whether or not you should be investing in alternative investments. I'm Wayne Zell, And thanks for listening to Blueprint for Wealth and our educational moment. And tune in next time for a special guest and another special topic. Have a great week.